Welcome back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. I'm your host, Murdoch. In today's broadcast, we're speaking with Josh Engebretsen, Portfolio Manager at Barwon Investment Partners, and he oversees the Barwon Disability Accommodation Fund. If you have any loved ones with special disability accommodation needs, or you've been following the SDA and NDIS news from the government, then I think you're really going to benefit from the insight Josh has to share on these areas. For people unfamiliar with these schemes, Josh unpacks exactly what is the National Disability Insurance Scheme and the Specialist Disability Accommodation. He shares his thoughts on what improvements should be implemented in these schemes, what risks to avoid when investing in this space, and how they are investing in specialist disability accommodation, which is both favourable for their clients and investors. The fund's been around now for 2 years, has a 5-year lock-in. The fund targets a total return of 8 to 10%, comprising of an income distribution yield of 5 to 7%. The fund for the past 12 months has returned 14%, with 4.85% of that being an income yield and 9% capital growth. Before we get into the podcast, I'd also like to encourage you to listen to the disclaimer at the end of the ROCast and to keep your feedback coming. You can reach me at mgatti@ywm.com.au. So with that being said, I hope you enjoyed this conversation as much as I did. So sit back, relax, and enjoy it. Josh Engebretsen, welcome to the Rate of Change with York Wealth Management.
Thanks, Murdoch. Thanks very much for having me here today.
Good to have you on. So who is Josh and how did you get into financial markets?
Sure. Well, I'm the portfolio manager for Barwon's Disability Accommodation Fund. I have a pretty squiggly path into financial markets, which is probably a little bit less conventional than most that find their way into funds management. So I started out firstly going to uni at Sydney University, doing a combination of civil engineering and economics, and so I actually was a civil engineer for a number of years outside of uni. Got more interested in the commercial side of real estate development and the real estate game, and so actually transitioned across into more of a development management style of role, so the commercial manager for real estate projects. But I moved across to a group called Ingenia Communities, which many would be familiar with on the podcast nowadays. But back then, it's a much smaller organisation, starting out developing what's now called land lease communities, or what we used to call manufactured home estates, which was effectively a new form of retirement living to challenge the incumbent deferred management fee model or rental retirement model. And that sector has grown quite substantially over time. And I saw it from both my time at Ingenia and then moved on to another ASX-listed group called Aspen Living Villages. And was with both of those organisations as cap rates in that sector came down from circa 10, 11% right down to around about 5.5% where they are now. So was quite involved in seeing how that new sector formed up, as well as other adjacent sectors as well that both of those companies worked in, which was caravan parks and FIFO mining camps and things of that nature, so alternative style residential accommodation. And then subsequently went on to be the head of property for a major telco and infrastructure business called BAI Communications, which provides all the backhaul infrastructure for ABC, SBS and Channel 10. And then went and actually studied my Masters of Applied Finance at Macquarie University and got more interested in the kind of financial markets or funds management side of real estate, and moved across to Barwon just over 2 years ago after a prolonged study of the SDA market and how it was shaping up, and came across Barwon, who had actually just themselves launched a fund in the Specialist Disability Accommodation sector, which I work in now, and decided to join forces to build an institutional grade funds management response to the specialist disability accommodation sector. So we've been investing in SDA for just over 2 years, 2.5 years now, and we've got a fund that's looking to be around about 80 million of GAV, and so that's how I find myself here today.
Yeah, that's an interesting path. They always say that the best person to essentially run a factory is the person that's worked on the floor, right? Not just the manager coming in over top, but that sounds like the path that you've had.
Yeah, it's been an interesting one. I mean, when I set out on my career, I always had that more commercial interest to me. Whilst doing civil engineering design for large master plan communities and other projects was really interesting. I found that I was drawn more towards the commercial management side, and I think the ultimate evolution of that is being very close to where the capital comes from, and being able to actually understand from the bottom up, like where allocating capital, particularly in physical asset class like real estate. You've got to understand how these projects actually come together, what's actually going to work for the end user of those different types of real estate, to be able to allocate capital well. So it's been a bit of a strange path, but I've been able to bring and adopt learnings across the technical front end through the project management, development management side, and now apply them, as a fund manager in the real estate space.
Yeah, and I think you might have for our listeners a very interesting insight from, like, I suppose, the three main vantage points, or where this interests a lot of Australians, which is, if you have a loved one, or you are yourself, acquiring, a dwelling, in the SDA framework, or the government stepping in, providing a funding framework to actually get these things built, and then thirdly, the developers themselves, seeking out to build these properties. And obviously no one does anything without trying to make profit, but there's always the good, the bad, the ugly inside that. But yeah, I would love to hear your thoughts on how essentially the community within this particular asset class operates.
Yeah, well, for the listeners that might not be so familiar with exactly what the specialist disability accommodation space is, I mean, it's a relatively new sector. It's really genuinely only 5 years old, so it's still, as a sector, growing quite rapidly, but still finding its feet. And at the end of the day, it's purpose-built accommodation for people with severe and permanent disabilities that have very high support needs, or a great degree of functional impairment. So it's for the very top, kind of circa 6% of lower functionality under the NDIS. And it's brought about by a rental stream that was created out of the NDIS, which is to incentivize the private market to build out this new dwelling category, or residential asset class. And so it's very much caters towards people with quite severe disabilities, but also you've got to take into account their families that are helping them make those decisions, but also because these residents do have a high degree of functional impairment, they've actually also need daily care. So you've also got to think about, how is that real estate offering providing a safe work environment? How are we making sure that that piece of real estate is near local amenities that carers can go and get a coffee or a sandwich at lunch? And of course, we've got, it being a very new sector, being only 5 years old, there's only about 6,500 places, or 6,500 beds built to date. And from the current metrics of how many need it, that's about 23,000 kind of need it now, today, or have eligible funding. So we need to be incentivizing and working with developers to create viable, profitable projects that they want to go out there and do the hard work to find the land and actually build this product, and build a good product for us, who are going to ultimately own it over the long term. So there's a number of different stakeholders in this space that you have to think about. You've of course got to think about, like any business and any real estate play, the end user, and that's our customer centric focus here on the participant, and making sure that we enable as an independent and inclusive life as possible. The carers, and making sure that property sits within an area that can be easily serviced with care. we've also got the developers that we need to take care of here. So you've got to actually think about multiple different components of how to bring together an SDA property, which is good, because I've kind of worn a few of those hats in the past, and it just helps you triangulate that.
Yeah, so with you were saying the other day that they had the SDA price guide review, right? Which happens, was it every 5 years? Is that correct?
Yeah, that's correct.
So with that, do you mind giving just an overview of the universe? Because this has been up and running for 5 years, and if anyone's been reading the headlines, you probably see headlines such as NDIS on track for a $5.7 billion budget blowout. Changes to the the SDA scheme to hopefully improve this. And I think I was chatting to someone the other day that made a comment that potentially, if it continues on this course, this particular scheme may become the single largest cost to Australians and the taxpayers going forward. So, do you mind giving fleshing out what are the real numbers, what's actually happening within the scheme? And you also said that you helped. Make some suggestions on changes with that particular review, and some were adopted. So I'd be really interested to hear all about that.
Yeah. Well, that's quite a big set of questions to unpack. But maybe if we just take it back to the beginning of what is the NDIS, because I think a lot of people's association with the NDIS is about budget blowouts, and that's much of the rhetoric that we do see in the paper. But let's maybe just take a little bit of a time machine back in time to why it even exists in the first place. So back in 2009, in that kind of era of the Gillard government, it was identified that we weren't funding care services in this country very well for those with a disability, and so they did a number of investigations, found out the money is kind of going to waste, or not being used effectively, or just actually not getting good outcomes for those vulnerable members of our society. And so they went and they said, look, let's actually flip the whole thing on its head. Let's turn it into a market-based system. So effectively, people who have severe and permanent disabilities, who may be eligible for this new thing called the NDIS, will do an assessment of their particular functional requirements, their level of disability, and will assign them a package of funding that they get to use to approach the market. So it very much turned it from the whole system on its head to a market-based system where a participant could go and find the care services that suited their particular disability, and to create greater choice and control. And that was really started being rolled out in around about 2011, and then really started going across the country in 2013. And so jump forward 10 years to where we are now, and we have 550,000 Australians who have a severe and permanent disability. Just remembering for a second, there's actually 4.3 million Australians that have some form of disability, but the NDIS is designed for the 550,000 who are deemed to have permanent and severe disabilities. And that 550,000 of people out there getting daily care, getting daily activities, or receiving things like SDA, that directly employs estimates of around 270,000 Australians, and indirectly many, many more. So it's a pretty big part of the employment and the economy at the moment. The last 12 months, I think the expenditure was around 34 billion, or kind of in that number, which is obviously a pretty big number, and that's about 1.5% of GDP, 1 to 1.5% of GDP. And so if you look at what's going to happen over the next kind of 10 years, the estimates at the moment, which is very much what people are alerted to, is that's growing to about 90 billion a year, and which is around about 2.5% of GDP. And to give you a sense of relative scale, that's around about the same size of the agricultural industry. So yes, it's a huge cost, but it also is a huge employer, and there's actually a lot of GDP that comes out of that as well, both the direct spend, but then the follow-on indirect spend as well, to all the support services that sit around to members who participate in that part of the economy. So yeah, look, the concern is from many people, we're concerned about what the budget is and how it's growing. However, what affects us in this specialist disability accommodation world isn't necessarily the overall budget, but it's actually the line item of SDA. So SDA is just a line item in the budget. It was created in circa 2015, 2016. They identified that the NDIS was doing a really good job in terms of creating a market-based system for delivering high quality services to participants. They're seeing a lot of great outcomes of the NDIS, but what was happening is there was still about 8,500 people kind of under the age of 55 in residential aged care, which is designed for people in their 80s who might be in their last series of life. There was a whole bunch of people stuck in community housing stock. There was a whole bunch of people stuck in government housing that wasn't modified for their needs, and so they created this new line item of SDA. And as at today, and kind of still from the beginning of the scheme, that budget is around 700 million per year. But as a sector in SDA, over the last kind of 12 months, we're collecting about 230 million of that. So the 230 million that is the SDA amount within the NDIS is actually less than 1% of the overall budget. And even if we were to be claiming the full amount, we're still kind of less than 2% of the overall NDIS budget. And I think that's really important for people to reflect on, particularly when thinking about investing in the specialist disability accommodation sector, because we're such a small part of the overall budget, but also our residences cater to those most in need, the most severe disabilities. And so if the government were to provide sustainability measures, which they will over time, much like they do most government programs when they get up and running, is we don't think they will get much of an efficiency dividend by taking on the smallest part of the overall NDIS scheme, which is actually for the most severe impacted by their disabilities as well. So a vast majority of that NDIS budget is around the daily provision of care, and supporting the 550,000 Australians, not necessarily the SDA component. And I'm sure there'll be sustainability measures over time. But when you look through to the rhetoric, is both sides of the political divide or the aisle do actually support the NDIS. There's no talk of wholesale scrapping of the NDIS, but when you look through to actually what's being said, they're saying we want to make it sustainable for those who it was originally intended for. And everyone can see the benefits that the NDIS delivers. So, what does that look like? What does that mean? Well, we'll probably just see some slightly heightening of the barrier to get into the NDIS, and maybe some funding tweaks around the edges. But, for those particularly in SDA part of the cohort, we think, that part of the NDIS will continue on as is.
Okay, so and then with the review, what were the suggestions that you made and that was taken on board?
Yeah, sorry, I didn't touch on that. So the SDA price guide review. So just to give people context, SDA is increased each year by CPI. So the rents to the sector are inflation hedged in that way. So each year since 2017, when the scheme first came into existence, we had CPI increases, which is linked to the March CPI. And each of those 5 years, we had an increase. And then every fifth year, it's written into the scheme or the regulation that the government undertakes what's called the SDA pricing or price guide review to basically check off the escalation in land and build prices versus the broader CPI basket. And so those on the call or listening to the podcast today might be familiar with how much land and building construction prices have increased over the last 5 years, and it was substantially more than the broader CPI bucket. So they go away and they undertake a number of investigations into land and building prices. I think they employed Ernst & Young to help them out with that and do a number of technical reports. They also engage quite broadly with the industry at large. So, everything from developers to fund managers like myself to SDA providers who actually, manage the day-to-day tenancies of the properties. And they do a really broad sweep of the market to understand what's working and what's not, on top of just the prices that need to be set at such a level to continue to encourage supply. And as part of that process, we here at Barwon did submit a discussion paper to the NDI just to say, hey, look, from a fund manager's perspective, this is what we're finding hard for us. This is what is working well, and here's a number of recommendations that we would make if you were, if as part of this process to make it easier for everyone. And so, fortunately, a number of those recommendations did make it their way in there. This was things like clarification or consideration of how GST is considered in the terms of building these things and selling these things. There was a little bit of ambiguity around that. Making sure that CPI, when it does index, goes up on the 1st of July. So what used to happen is you would have your rents go up for the sector. That actually wouldn't flow through to your asset until the individual participant's plan renewed, and that wouldn't necessarily be on 1 July. That might be in November, December, or March next year. Making sure that there was more clarity around the participant demand and supply data, or the dwelling demand and supply data, but also ensuring that there was a lower margin or a narrower spread between different levels of funding packages. And so I'll just dwell there for a moment. So in the NDIS or under SDA, there's actually 4 funding packages, depending on your level of functional impairment or level of support need. And so I won't go into all 4, but in essence, what used to happen between the highest funded package and the lowest funded package was about 50-55%. And so when you think about building one of these properties or buying one of these properties, if you've got to buy the land, it's probably the same, whether it's the highest funded person or the lowest funded participant. When you think about the broader structure of the building, it's broadly the same. When you actually got down to it, there was probably a 15 to 20% difference. And so that kind of 55% difference in income didn't really make a whole bunch of sense to a lot of us in the industry. So look, a lot of us must have put forward the same kind of suggestions, but they brought that narrowing of the highest to lowest funded down to about 8%, and that kind of had 2 major impacts on the sector, or at least our portfolio. One, it de-risked the assets that we already had, so we had a large number of our people in our portfolio were on that higher funded rate. And so there was always a possibility you might lose someone at a higher funded category and then replace that with someone at a lower funded category. So it de-risked the portfolio from that income reversion perspective. But going forward and working with developers, we would always have this tension between we might build it, expecting the highest funded participants to come to the property, but that actually might not eventuate, and we might only be able to attract lower funded participants. So there was always this expectation difference around what the revenues of an asset might be. Well, bringing those substantially closer together made those conversations a lot easier, now to the point where we're working with developers and they're saying, oh, we're happy to underwrite it just at the lower funded participant level. And if you're able to get higher funded participants there over the long term, then that's okay, but it still works for us at the lower funded level, which makes it much easier to bring on more supply to the market. And thirdly, from kind of a social perspective, it's now nicer to be able to offer our stock to a much wider range of participants, because we don't have that, I guess, that tension around the level of funding gap that was previously there.
Thanks for that. So that's the overview on the space. What's actually the strategy of Barwon? Because a number of people will be reading, you probably see it over social media. There's a number of people out there. I get clients emailing me, go, "Hey, there's this new NDIS scheme. It's making 15% or higher." But I'm concerned that it's in the middle of nowhere. Is this actually a good idea? What do you think? What in your opinion, running this strategy and what return, should people be expecting, from your portfolio or from these assets, and where should these assets be located?
Yeah, well, I'll go probably touch on who Barwon is and how we found our way to this space. So Barwon is an institutional grade independent fund manager based in Sydney, but with offices in Brisbane and Melbourne as well. We were set up in around about 2006 by the former head of alternatives at Macquarie Bank, Sam Armstrong, and the former head of real estate at AMP Capital, Rob Morrison. and joined by their third partner, Peter Connors. And so we've been investing on behalf of institutional grade groups, so predominantly super funds, other institutional groups, and high net worths since that time. And today, the business has got over 50 people, and we manage over 3 billion of capital on behalf of our institutional or highly sophisticated clients. We're wholesale or institutional only, and I think that's quite important. And we've been investing particularly in healthcare real estate for around about 10 years. So we've got two funds in that space. We've got an institutional healthcare fund, and that's for a number of super fund clients across Australia that has around 1.5 billion invested in healthcare assets across Australia. And that's your predominantly larger tertiary or larger secondary style assets. So think large private hospitals. And then we've also got a fund which is more for our high net worth and sophisticated clients, which is around about 500 million. And that invests in predominantly GP clinics and allied health clinics and maybe smaller day hospitals, things like that. So we've been investing heavily and directly in property for over a decade, and we've got around about 2 billion invested in that space. And with that, we've got probably one of the largest dedicated asset management teams in the country to managing those real estate properties. So I mean, that's everyone kind of, some people think that real estate is a passive game. No, it's very much an active management game. And so from that experience in healthcare, we had a lot of our healthcare providers talking to us and saying, hey, we've got a large number of people with disability stuck in our hospitals, or some of these healthcare groups would have disability care provider arms, and they'd say, hey, have Barwon heard about this new sector called Specialist Disability Accommodation? Because it actually really needs an institutional grade manager to come to it and actually do this properly. Because like what you just mentioned, a lot of us were seeing groups and Facebook ads and all kinds of things promising crazy 15 to 17% yields, with properties kind of in the middle of nowhere. And people were really concerned that that wasn't that type of product actually wasn't going to be the best outcome for participants. You can most certainly look at the SDA price guide and see how you might quickly want to derive a 15 to 17% return. And that's because you can go and buy the land really, really cheap somewhere and build a really, really cheap house. And, on the back of a spreadsheet, you can create a 17% return. And a lot of that did happen. Like any good government scheme, unfortunately, there was a lot of people that came out and thought it was a bit of a get-rich-quick scheme, and they piled into the sector. So when you think about, how's that, impacted? Well, if you look at Southeast Queensland, there's roughly twice the number of SDA beds built than those with SDA funding, right? So that's a massive oversupply. And that's predominantly come from that property spruiker, into the self-managed super fund style of market. If you double click on Southeast Queensland and you zoom in a little bit more on a micro level, the majority of that supply is coming in on Caboolture, Ipswich, and Logan. And what's the thing that kind of ties those areas together? Fringe, really cheap land, and a lot of people piled in. So, that was some unfortunate consequences that have come out to it. We think on a kind of diversified portfolio level, and it very much aligns with the government calculations on this, which are published for everyone to see. So the government really designed this scheme to have sensible, normal, kind of relatively risk-adjusted returns like you would see against other asset classes in real estate, kind of in that 8 to 10% total return with a distribution yield of kind of 5 to 7%. That's broadly what the government has published of how they think about rent should be set, not the kind of double-digit returns that have been promised by some groups appealing to that more of that retail type of investor. And so that's what we've been building our fund to deliver. A big focus for us is not trying to drive for yield or yield on cost, but actually solve for occupancy and minimizing vacancy. A lot of that stock in Southeast Queensland is just not occupied because it's just so much saturation. Whereas fortunately in our portfolio, we've got 100% or near 100% occupation, because we make sure that we buy assets that are really close to amenity, have a good underlying land value, that are in areas deeply serviced by care, that are places that are going to attract and retain tenants over the long term. Because if you're solving for a 15 or 17% margin and you're choosing maybe an extra 5 or 6 kilometers out of town than you probably should be, well, someone like ourselves who have a different type of approach, that kind of solving for the long-term sustainability of the asset, where we're happy for that 8 to 10% total return, we'll just go and buy a plot of land and work with a developer to develop an asset right next to the shopping centre, right in town, and that's going to be much more attractive to participants over the long term.
On the mechanics of that, you said a number of things which are very interesting. Can we just jump into the mechanics? So, what's you said target 8 to 10%? What's the average return for the past 12 months? What are you forecasting?
Yeah, so the fund is 2 years old. So, happy to talk around total return to date, but let's start on the last 12 months. So the last 12 months, we had a total return of just over 14%. And that was driven by around about a 4.8% income distribution yield, so real cash distribution to our investors, and a circa, kind of 9 to 9.5% capital return. Now, the capital return was greatly supported this year by the SDA price guide review that we talked about earlier. So for funding packages in the sector, we had an average of 18.5% rental increase this year. That was mostly against the lower funded categories, as I mentioned, so bringing those up towards the higher funded categories. So our portfolio benefited from that increase, and also we bought some assets quite well. If you look at the kind of return to date, I think we're around about a 7.5% total return, but we've got to remember the first 12 months we had lots of deposits out the door and kind of things not earning monies, which kind of dragged the returns for the first 12 months. We'd probably say the last 12 months is fantastic for existing investors, but not a guide going forward. We would expect, again, that 8 to 10% return is our outlook, with a 5 to 7%, real cash distribution yield.
So on the cash drag, we chatted about this, at lunch the other day, which was very interesting. How does say you spot an opportunity, you want to pick up this fund, you want to work with a developer? Does the fund do investors just allocate money to the fund, the cash builds up, then you go find an asset, or do you go find an asset, then you open the fund up to invest? How does it work?
Yeah, well, when we originally set up the fund, it was a capital call structure. So investors would pledge a certain amount that they were willing to invest, and we called that down progressively. We've now deployed all that capital, and we recently put in a major bank facility, about $40 million with ANZ. So we're well supported from a debt perspective by Australian major banks. We ran a process, and ANZ was the winner of that. So going forward, a couple of acquisitions we've got in the pipeline at the moment, where we're using that available debt headroom to us and making sure that all acquisitions are distribution accretive. And then for future capital raisings, which we've got a capital raising at the moment, what we're looking to do is just immediately unitize our investors against acquisitions coming into the fund, or pay down debt, small amounts of debt, but then use that debt headroom to immediately then re-roll into new acquisitions. So in terms of cash drag, there's a big focus on not having any cash drag in the fund. And so we'll do that by really managing the debt profile, or raising in time and in line with new acquisitions.
And how long does it take to get money into the fund, and what are the redemptions?
Yeah, so pretty quick to get money into the fund. So we've got a capital raising at the moment. We're looking at closing that around 8th of December. Because these assets
How
are
much are you raising?
looking to raise 10 to 15. That's the target this time round. But we imagine that going forward, we'll probably do more frequent but smaller style raises, so around that 10 to 15 mark. These assets are generally quite small, an average ticket size of 5 to 10 million. So we want to be batching a few of those together before we do a raise. And so we imagine we'll just be doing those in more frequent installments. So it's pretty, easy to get the money in. In terms of getting the money out, this is an open-ended fund, but with close-ended features. So the liquidity profile is there's a redemption window every 5 years from the birth date of the fund. The birth date was May 2021. So the next one will be in May 2026. So about 2.5 years away from now. And then every 5 years after that. Of course, we do for, really extenuating circumstances, divorce or death. We'll try and help our investors if they need liquidity, but we can only offer that on really a best endeavors basis. By matching them off against other investors that want to come in. We do try and help our investors where we can, but we do offer those redemption windows as well if they want to redeem larger amounts of their capital.
Okay, so talking about the opportunity of purchasing these assets, how does it work? Does it so I'm in Lane Cove. It's
Yep.
I think Lane Cove just got voted like one of the most upcoming suburbs, right? So assuming, say, you have families or loved ones, someone's got someone disabled, they want to be close to home. There's some assets around, but there's no real complete knockdown buildings. Let's throw up, I don't know, 10. In one particular place, how would you go about exploring your product for Lane Cove as an example?
Yeah, so I think there is some SDA actually coming up in Lane Cove, not by us, but by others. I was just out this morning looking at our new project in Macquarie Park, actually, and we've got 20 units coming up there. But typically, we start off at a very macro level. The NDIA publishes really good data. It's not always, the most reliable, but we take it as directional, and it's pretty good from that perspective. So they actually do post where all the new supply is coming online. So there's a 2-step process in registering an SDA dwelling within the NDIS, and as a result of that 2-step process, they have really good data about what's in the design phase and what has been completed. And then secondly, because they've got all the address data of all the SDA participants, they've got a pretty good idea of generally where they live. And so you can use that data to kind of at a macro directional level, first start to identify where are the major pockets of oversupply and where are the major pockets of undersupply. So we would start kind of there. And, you'd broadly say the North Shore or Lane Cove area is probably very undersupplied. By virtue of the fact that there's actually not a huge amount of new stock coming on there generally in the residential market. And if they do, the land price is very, very expensive. So probably to date, it's been a bit exclusionary from SDA. But if we did have a developer there that was looking to do a larger scale development, say 300 or 400 units, we would either get in touch with them or they would get in touch with us, or one of our SDA providers or care providers might know that developer or whatnot, and they might approach us with an opportunity to buy SDA units out of that particular development. So we would work with that developer to understand what changes would need to be made to their project. So, all projects probably across Australia need to be DDA compliant or in line with the disability design requirements. But there's an additional level to get the SDA standard. So it would work with them to figure out, if we can get their building, if we can get these SDA units into their building. We would then work with them on the price point that we could afford to pay, run that through our models. And then basically we would contract with that developer or that builder to deliver us those SDA units when they complete the project. And so that particular project would first require an SDA design certificate, where we employ a specialist, sector-specific SDA assessor or certifier to review the designs and sign them off. And then secondly, after a series of inspections through the build, that SDA assessor will then sign off that it has been built to the correct standard, and then it's certified. Once it's certified, that package and that documentation goes off to the NDIA itself, and they have a team in there that reviews the plans, reviews the certification, and actually then issues you a certificate of enrolment. And once we receive that certificate of enrolment, that's when we acquire or settle on the property and start to to advertise it to lease it up. Well, in truth, we're actually advertising kind of 6 to 9 months out, but that's when we have an opportunity for participants to actually come through the premises. And for this particular cohort or customer set, it was very similar to what I experienced in the retirement living sector. Moving is a really big, life event for many of us. But much even though it's as difficult as it is being fully able-bodied, for those who do have high degree of functional impairment, who require very much on external service providers on a day-to-day basis, moving is a really big deal. So they want to look, touch, and feel the product generally before committing to move in there. So we'll often, if we can, negotiate a display suite to come forward. So we can help those participants understand what they'll be moving into. But yeah, once we settle, we then advertise and start providing leases to our tenants. And hopefully those moving in choose it as their forever home and going to stay with us for a very long time.
Hopefully. So, how does the relationship work with the developers? Do you give them access just to lending, or you provide the equity piece? How does
Yeah,
that work?
yeah, different approaches for different types of developers and different types of product. So that product I just spoke to, where we might be buying 10 units out of a much, much larger residential development, we'll just enter into a forward purchase agreement, much like any person buying off the plan would enter into. That when that project is built, certified, and enrolled, we'll then settle on the property. So whilst we don't give them finance, we do give them a contract which they can then take to the bank as part of their pre-sales commitment to go and get financing. For other projects, we'll buy them as going concerns. So a developer might have already built it, got it enrolled, and they've actually wanted to extract as much value as possible from the deal. So they've actually got it fully leased up, and then we'll look to just buy that off them. The third option we offer, for our most trusted developers, is what we call a fund through agreement, and effectively that's a finance to own structure. So a developer might have a project that we really, really like. For some reason or another, they don't want to go with a third-party bank. They would prefer us to finance the entire development. Maybe they don't have the 50% equity that would be required to do the development themselves, but they've got a really good project. They've got a good team around them. They've got a good builder in place, and we can go and review all this. We'll actually, when they achieve a certain milestone, which is usually linked to getting the appropriate planning approvals in place, getting the as-built certificate, and getting a building contract, lump sum building contract in place, so we have clarity on the feasibility of that asset. We'll actually then buy the land at that point and then finance through the rest of the construction. And so in that way, when they achieve, enrollment and certification and leasing up of the property, that's at the end of the project, we actually pay them out a development profit. But we also get to charge a coupon on all that money that we've provided for that project up until completion. And so in that way, we're able to pass all the development risk and the leasing risk to our counterparties, and we just get a smooth return for our investors.
Considering the rates currently, what would you charge on that money?
Yeah, when you think about, we basically apply a similar way that you would look at it, the overall debt and equity for a project. So let's just make it for easy maths here, 50-50. So we would say 50% would need to be equity. Development equity at the moment can range anywhere from 15 to 20%, depending on who you are or the type of project. If it's a simpler single-story project with a guaranteed takeout, maybe equity is a bit cheaper. And then if you're going to get debt, you might have 50% at kind of anywhere between 7 and 10%, depending whether you can get a major bank to sponsor you or whether you need to go to a private lender. And so you kind of multiply those two together, and you're looking at an all-in cost of capital, maybe circa 10 to 13%, somewhere in that range.
Cost of capital is 10 to 13, and then you take ownership of the asset and then lease that asset out to the users within the SDA scheme.
Yeah, so we'll charge a coupon somewhere in that 10 to 13% range for finance. So all of the capital, remembering in that fund through structure, the developer at that point has been paid back for the land. So they've got
Mm.
all their money back out of the project. So it's all then our money going into the project. Now we do have, obviously, uh, you know, overview and oversight and audit requirements on how that development's going, but the developer then takes all those construction time leasing risks, and we charge our coupon in the background. And then at the end, when it's fully complete, we pay out the remaining development profit, and then we've got a leased asset, which is going concern that by that point, and so we're just getting then the return that we've paid for the asset.
So once you have the asset and then you're managing the portfolio of these assets, what's the hidden ongoing costs? Like a number of these are strata buildings, right? I think we had a conversation about a friend of ours who essentially got hit with a very large bill because the balcony railings were what 0.8 of a centimeter below what they should have been. So now everyone's up for a very very large bill, right? So who cops that cost? Is it yourself or is it the tenant?
Well, it depends. So we've got different leasing structures in this sector. So we would have what lots of real estate investors might be familiar with, which is a triple net commercial lease style structure. Under that structure, there may be provisions or carve outs that any capex is actually the responsibility of the tenant, so not the responsibility of the fund or to our investors. And then we do have other types of agreements which are called pass-through agreements or pass-through leases. They're effectively management agreements registered on title, which mean it's actually the fund's responsibility if there was any capex or if there's any vacancy that we take that responsibility. If you look at kind of just an OPEX or ongoing operational kind of cost of particularly the pass-throughs, you might expect somewhere in the kind of sense of 20% of the income does go to property outgoing. So that's both the property and the SDA managers who charge anywhere from 5 to 15%, depending on which group you're talking to. And then the capex, we make allowances in the below the line for capex. Of course, the majority of the assets that we're buying at the moment, the sector's only 5 years old. Particularly, it started ramping up. So you'd say the average age of an SDA is probably, in the 2 to 3 year old kind of bracket. So these are all very new properties. So investors in the early stages of this sector do actually benefit from depreciation and tax deferred nature of the rents. I think in our last quarter, 84 cents of every dollar returned was at tax deferred status. So you do have the depreciation benefits. But yeah, going forward, there will be capex like for any kind of asset class or real estate asset class, and in some instances that is for the fund, and some instances it's actually for our tenants. But in all instances, we do actually model that all in and make sure we're still getting our target return after consideration for capex.
So it sounds like you're running things quite well, but even for yourselves, there's always risks, even if you do it on the conservative side. So where do you think the risks are for Barwon's strategy?
The biggest and most obvious risk, which we get feedback from our investors on, is just the government regulation risk around SDA and the NDIS. As we talked about at the beginning of the call or podcast, that the SDA component, we feel comforted by the fact that SDA is such a small amount of the NDIS budget, and SDA caters towards the most people who need the NDIS, that from an overall regulatory perspective, that SDA is protected. But of course, we can't give absolute guarantees around that. However, it's very much written into all of the information that's published about SDA that it is here to stay, and it has kind of at least a 20-year life on it, which is how we model our assets, that they've kind of got a 20-year life and then they revert back to existing stock. So that's probably the biggest and most obvious risk. The next one is, which concerns me more broadly for the sector, is what I call product obsolescence. So when you think about the iPhone, when you go to get a new iPhone, you're never going back to the iPhone 1. you're always going to, what's the latest, what's the last couple of generations I can afford, or if you can afford it and the budget, in your personal budget is unconstrained, then you go for the latest iPhone. So there will be more supply that comes into this sector over time. And so you want to make sure that the stock that you're buying and owning is going to last the test of time. So it's going to be attractive to participants now, and it's going to remain attractive over the long term. So it can't easily be usurped by someone building an asset closer to the shopping center, closer to employment or education opportunities. You want to make sure that your portfolio is safeguarded for that increased supply that will inevitably come in over time. Now, the last one, which I was more concerned with, prior to the price guide review than I am today, was the income reversion. So what happens if you do have assets that are full of higher funded participants, and slowly over time, they unfortunately need to move on or move out, and they're replaced with lower funded participants. Whilst we did factor into our modelling income reversion occurring over the first 5 or 6 years of an asset to what we deemed a more sustainable tenant mix, much of that has been offset by this SDA price guide review, so that doesn't worry me as much anymore. So those would probably, what we hear from investors is, the regulatory risk, which is there, but we don't think it's so present for SDA, but also the making sure that we've got the right assets that stand for the test of time. That's probably the biggest thing that we're focused on.
Well, unfortunately, no one's been able to recreate Roman concrete. So, things like concrete cancer and, the age of a building and the maintenance of that building. What happens, as this is being built for 20 years, these are all new dwellings being purchased, right?
Yeah.
But, you just look at every single suburb, beautiful houses 30 years ago, they get old, tired. Does that keep you up at night? Considering, yes, there's changes to the regulatory scheme, but the dwellings will need in your portfolio rejuvenation in time. Like, how does that get factored in?
Yeah, I mean, this is the very reason why we have, the house view that real estate is not a passive asset, and why we have built in Barwon a significant asset management team to help maintain and improve our assets across all our funds. So across the healthcare funds, it's very much the same thing. So how do you make sure your assets remain attractive to the existing operators or GPs who are there at the moment? And how do we make sure that those existing those operators expand with us over time instead of moving into bigger premises? How can we increase their footprint on the same piece of land? Is a very similar mentality to how do we maintain our assets so that they're attractive to our NDIS participant clients over the long term. So of course they're going to need upgrade and rejuvenation, but we factor that in. Each asset, how it works in SDA is they actually enrolled for what's called the new build funding for 20 years, and then they revert to existing stock funding. And so, when we think about that, we look at a few different scenarios. One is that they do return to existing stock funding, and that rent drops by about 70%. Two, we look at, maybe that asset is tied by that point, and it would be better if for residents there may be new product that's sprung up locally, and they might want to move across to that new product. So then we have a certain amount of refurbishment to take it back to residential and then sell it on the market. And then the last option, which we include in our analysis, but we don't rely on in terms of our performance or underwriting of the assets ahead of acquiring them, is actually refurbing them and then getting another 20-year life out of them. So as at today, there's no mechanism in place to basically recertify a new build dwelling and get another 20 years. It can only revert to existing stock. My sense is that will probably change over time. The government, in 10 years' time may say, hey, we're facing a bit of a cliff here where, 5 to 10,000 residents are going to have to move out of their homes potentially over the next 10 or so years. Do we really want to rebuild a whole asset class again from scratch? And then maybe a scenario where you actually do a larger style refurbishment and then release it out again for another 20 years as new build stock. So yeah, like any other real estate asset class, it's not immune from having to do upgrade works, but it's fairly low touch, kind of in keeping with what you would see in other residential properties.
So with the coming year and the coming years, as you said, you look at macro, as in where you're going first. You've got to raise on as well. With those assets you're looking to pick up, where do you see the opportunity currently in the market?
Yeah, I mean, there's a little bit of the magic that we don't want to give too much away and tell everyone all of our ideas. But there's definitely places we want to, be very careful on, and then very other places that we're very bullish on. Broadly, there seems to be a real push. If you talk to the underlying customers, that they want to have, where possible, sole occupancy as opposed to shared. So they would prefer to live in a one bed villa or apartment than necessarily have to share with other people. Now, the tension there is that the NDIA, because it's more cost effective to do so, would prefer to provide shared accommodation funding. So that's kind of one balance that we think about. The next is that supply demand dynamic. So northern parts of Adelaide, southern parts of Adelaide, lots of parts of WA, stretches of Victoria, we really like. Whereas also all across New South Wales, anywhere that's kind of really structurally undersupplied. And then there's these pockets of extreme oversupplied. So northwestern suburbs of Melbourne has a significant amount of SDA units. That's somewhere where we have the amber or orange light on, and also that southeast Queensland example that I spoke to earlier. Not that we wouldn't go anywhere in southeast Queensland, but particularly places in like Caboolture, Logan, and Ipswich. We still remain very cautious in areas like that.
So, Josh, with all that being said, what keeps you up at night and what gets you out of the bed in the morning?
Great question. What keeps me up at night? Not too much at the moment. I mean, to date, the sector's been fairly well buffeted from interest rate rises. Against say other core asset classes that 12, 18, 24 months ago, you were seeing really core Australian real estate trade in the kind of 4.5 to 5.5 range. We were buying assets in this sector at a substantial spread to those core asset classes. So anywhere from 6.75, 7 up to 7.5 to 8%. So with our cap rate substantially above the risk-free rate, we've been a bit protected from that support of cap rate expansion that we've seen in other sectors, which has been good for SDA. However, if central banks continue to have to fight the inflation fight and keep ratcheting up further, there will be at some level or at some point that will start affecting SDA. Today we've been buffeted, but you never know what might come down the line. The second is making sure, which probably is the answer to both questions, is just making sure that we've got the right property that's going to keep our tenants happy, and we've got the right care provider partners and the right SDA or property manager partners to make sure that our tenants are happy and want to stay with us. And so that's both what keeps me up at night. We are dealing with a really vulnerable part of our society. We want to make sure that we're setting up real estate and agreements and systems and processes that those people are being taken care of. But also that's what gets me up in the day, because it's really nice to be able to go to work and, whilst we work in this fairly esoteric world of finance sometimes, at the end of the day, the product that is actually being delivered on the ground is making a pretty substantial difference to not only that resident or that participant's life, but also to their family. We went to an opening of our High Wycombe asset, which is in Perth, earlier this year. And it was just fantastic to meet with the residents that were coming into that property, meet with the families. You've got to remind yourself that many people with disability are kind of in that 40 or 50, maybe late 30s to 50 kind of age bracket, meaning their parents are in their kind of their 80s, and very much are concerned about, when they're not around, how their children are going to live and where they're going to live. And so was really lovely to hear, some of the relief in the voices and the commentary around some of these parents, that their child is actually going to live in a really nice brand new property that they can be proud that their child is living in. So, big focus on making sure that we've got happy participants is both what keeps me up at night, but also gets me up in the morning.
You just jogged my memory. One of the questions we discussed at lunch was I found quite interesting. Is it correct that there is no um financial limitations on what someone can access as a property? Like you don't require a minimum income, or your family doesn't need to be incredibly wealthy to be able to apply for one of these dwellings. There's
Yeah, correct. There's no means testing.
no means testing. Yeah.
Yeah, no means testing. It's very much a system set up around your level of disability or level of impairment rather than your economic means or that of your family. I mean, the majority of people who have have a family member with a disability. It's quite, it used to be quite a large financial impact. Today, it's been made much easier by the NDIS, and financial impact not only for maybe the specialist equipment they needed, but the time of work that was time out of work that was required to be able to care for that loved one, has quite a large impact on the family. So it's great to see that the NDIS can actually help support those families as best as possible and reduce that economic burden. But no, it's not means tested.
Yeah, look, it's been great having you on and listening to your thoughts because, as we discussed earlier, this has been running for a while, and there's, obviously with any scheme, there's a whole lot of people that want to come in and, excuse my French, take the piss. But it's good to see that good operators like yourself are literally giving, hope and comfort to families, where essentially they can live close to loved ones, right? It's a very good scheme, which is what's occurring. If anyone was to learn more about Barwon or the opportunity you currently have right now to access the investments you're looking to pick up, how are they best to find you and learn more about what's happening?
Yeah, look, I mean, there's a few different ways. The most obvious one is our website, which is www.barwon.net.au. A simple Google search is of Barwon Investment Partners or, Barwon Disability Accommodation Fund. We also have some videos on YouTube, detailing our quarterly updates as well as some tours of some of our assets and even some industry style podcasts and kind of webinars that we've hosted as well, where people can do a little bit of self-learning before getting in touch with one of our business development teams. So either Kate Hayward or Brett Scallon. There'll be an opportunity to either get in touch through our phone line, which is on the website or on Google, or there'll be an inquiry form there as well, and one of our business development representatives will be able to get in touch with them.
Well, Joss, it's been really good having you on. I've really enjoyed this conversation, so I really appreciate it, and I hope you have a great day.
Thank you very much, Murdoch. It's great to connect and chat here, and thanks very much for having me, and all the best with this great podcast of yours.
Thanks, Joss. Have a great one. Bye.
Thank you.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.